You likely have money sitting in a savings account right now. Maybe it's 5 lakhs, maybe more. It feels safe, right? It feels responsible. Well, welcome to this explainer. Because today, we're going to completely shatter the illusion that keeping all your money in a basic savings account is a secure financial move. In fact, it's actually a silent wealth killer.
Every month, you probably log into your banking app, see a small interest credit, maybe 1,000 rupees or two, and you feel a quick sense of satisfaction. You're thinking, great, my money's growing. But here's the uncomfortable truth about what's actually happening behind the scenes while you sleep. Your money isn't growing at all, it's actively shrinking. And this number right here is exactly why, 2.6%. You see, due to the massive gap between the interest your bank pays you and the actual rate of inflation, your money is actively shrinking. You're losing 2.6% of your purchasing power every single year that your cash just sits there idle. Over a decade, that compounds into a truly devastating loss.
Section 1. The illusion of safety. Why savings accounts fail. Let's start with the baseline facts. Most major banks in India, we're talking institutions like SBI, HDFC, and Kotak, are paying you around 2.5% per annum on your savings deposits. Now compare that to the real world. The RBI projects inflation for the 2026 to 2027 financial year at 5.1%. So your account gives you 2.5%, but the cost of living goes up by 5.1%. That difference? That's your wealth literally evaporating into thin air. 5 lakhs today will only buy you what 4.87 lakhs buys just 1 year from now.
Section 2. The math behind the loss, 10-year wealth erosion. If you leave 10 lakhs completely untouched in a savings account for 10 years, your bank's going to pay you about 2.8 lakhs in interest. Sounds okay, right? But wait, because inflation will eat away 6.4 lakhs in value. That means you're effectively losing 3.6 lakhs in pure purchasing power. Think about that for a second. That's enough money to buy a small car, completely gone just because you thought your money was taking a safe nap. Got a 50 lakh balance? That is a staggering 18 lakh net loss in purchasing power.
Section 3. What you are missing. The opportunity cost.
But unfortunately, the inflation penalty is really just the beginning of the bad news. The real damage to your long-term wealth comes from the staggering opportunity cost of not investing your money elsewhere. If you have 5 lakhs in savings at 2.5%, after 10 years it grows to 6.4 lakhs. But if you'd invested that exact same 5 lakhs in an equity mutual fund earning an average of 12%, you'd have over 15.5 lakhs after a decade. By choosing the comfort of a savings account, you're literally leaving over 9 lakhs of extra earnings on the table. Even incredibly safe government bonds yielding around 7% would give you over 3 lakhs more than your standard savings account.
And this brings us to a brilliant principle, a core financial rule in India known as the 10-5-3 rule. This rule sets realistic expectations for your money. You can expect roughly 10% returns from equity mutual funds, 5% from debt funds, and a mere 3% from savings and fixed deposits. It shows you exactly why your savings account belongs at the absolute bottom of your wealth-building pyramid.
Section 4. Behind the scenes, the bank's secret. You might be wondering, if inflation is so high, why are savings account rates kept so aggressively low? Well, it's a brilliant business model, for them at least. Banks take your deposits and pay you a measly 2.5%. Then they turn right around and use your exact same money to fund loans. They charge home buyers 8 to 10%, and they charge personal loan borrowers 12 to 15%. They're essentially paying you pennies while pocketing a massive 5 to 7.5% profit margin on your hard-earned cash.
But you know what? The secret is out, and the market has finally realized this game. The smart money is quietly making an exit. The share of savings deposits in aggregate bank deposits plummeted from over 34% in 2022 down to just 28.7% by March 2026. People are waking up. They're actively moving their money out of basic savings and into vehicles that actually work for them, not just for the bank.
Section 5. The real-life impact. Everyday savers lose out.
Let's meet Rohan. Rohan's a responsible guy. He keeps a 3 lakh emergency fund in his savings account. He doesn't touch it, but after 5 years, while the nominal balance went up slightly, inflation secretly robbed him of 40,000 rupees in actual purchasing power. His 3 lakhs now only buys what 2.6 lakhs used to buy.
Then we have Priya. She's saving up 10 lakhs for a down payment on her dream home. Because she needs it relatively soon, she keeps it in her savings account. Yet, in just 3 short years, her supposedly safe money lost 70,000 rupees of its real-world value. And finally, Amit.
Amit parked a massive 20 lakhs in his savings account for an entire decade. He suffered a devastating 4.5 lakh loss in purchasing power over that time. This is the ultimate irony of playing it safe. By trying to protect their money from market volatility, Rohan, Priya, and Amit practically guaranteed that they'd lose value to inflation.
Section 6. Your new action plan. Stop the financial bleed.
Recognizing the problem is step 1, but step 2 is executing a structured, fail-proof strategy to fix it. Here is your exact step-by-step action plan to take back control of your wealth. Step 1. Calculate your absolute minimum needs. You should only keep 1 to 2 months of living expenses in your basic savings account for daily convenience. Step 2. Open a liquid mutual fund for your emergency cash. You can earn 5.5 to 6% and still withdraw within 48 hours. Next, step 3. Set up an auto FD. Then, step 4. Consider government bonds. And finally, step 5. Start a monthly SIP in equity funds for money you won't need for 5 or more years.
I really want to highlight step 3 here because it is an absolute game changer that requires zero effort once it's set up. It's called a sweep-in fixed deposit, or auto FD. You simply ask your bank to set a threshold on your account. Anything above that amount automatically sweeps into a fixed deposit, earning an incredible 6 to 7.5%. The best part? If you need to make a transaction and your savings balance is low, the bank automatically sweeps the exact amount back from the FD. You get higher returns, zero risk, and instant liquidity. It's a complete no-brainer.
And for those of you who want absolute safety for the rest of your cash, seriously consider government bonds. Through the RBI Retail Direct platform, you can buy sovereign-backed bonds yielding up to 7.45%. You don't even need a broker anymore. The secret's out on this too. Account adoption for these government bonds is surging, growing at an incredible 54% year over year.
I want you to literally burn this quote into your memory. Your savings account is not a savings tool. It is a convenience account. It's meant strictly for paying your daily bills, buying groceries, and routing your transactions. It is absolutely not the place to build or even attempt to protect your long-term wealth.
So as we wrap up this explainer, I have a direct challenge for you. Log into your banking app today. Take a good look at that balance. If you have more than 1 or 2 months worth of expenses just sitting there idling away, it's time to make a move. Stop letting inflation eat your hard-earned money and stop letting the banks pocket the profits that should belong to you. Take control, reallocate those funds, and put your money back to work. Because if the banks are this good at building wealth using your idle cash, imagine what could happen when you start acting like the bank. Until next time, keep exploring.